Analyzing the current yield curve. U.S. Treasury yields as of today. 1-month yield. 5.113%. 1-year yield. 5.256%. 2-year yield. 4.731%. 10-year yield. 3.713%. 30-year yield. 3.802%. The current shape would be described as an inverted or flattened yield curve rather than a normal yield curve. In a normal yield curve, longer-term yields are higher than shorter-term yields, reflecting expectations of economic growth and higher inflation in the future. In the case of an inverted or flattened yield curve, such as the one implied by the given information, 10-year yield lower than 2-year yield, the shape suggests a more cautious or uncertain economic outlook. Economic implications. An inverted or flattened yield curve often raises concerns about potential economic weakness or a slowdown. It can be interpreted as a sign that investors have lower expectations for future economic growth and may anticipate a potential downturn or recession. Financial market implications. The inverted or flattened yield curve can have various effects on financial markets. Equity and crypto markets. The inverted or flattened yield curve can be perceived as a signal of economic uncertainty and potentially impact investor sentiment. It may lead to increased market volatility and a cautious approach among investors, which could influence stock prices. Economic and corporate earnings data, as well as other geopolitical factors, should be considered in conjunction with the yield curve for a more comprehensive analysis of equity market performance. Fixed income markets. Inverted or flattened yield curves can impact fixed income securities. Short-term bonds typically benefit from lower yields, while longer-term bonds can face downward pressure on yields. This dynamic can affect the pricing and performance of fixed income investments. Mortgage and credit markets. The relationship between the yield curve and mortgage rates can also be influenced by an inverted or flattened yield curve. Mortgage rates tend to align with longer-term yields, so a flattened or inverted yield curve may result in lower mortgage rates for longer-term loans compared to shorter-term loans. This can impact borrowing costs and potentially stimulate demand in the housing market. Factors influencing the yield curve. The factors influencing the shape of the yield curve remain consistent, regardless of whether it is normal, inverted, or flattened. These factors include central bank policies, economic indicators, market sentiment, and investor demand, as mentioned before. It's worth noting that the shape of the yield curve can change over time as economic conditions and market expectations evolve. Regular monitoring of economic indicators and the yield curve is crucial to gaining a comprehensive understanding of the potential implications for the economy and financial markets. In summary, the current inverted or flattened yield curve, with the 10-year Treasury yield lower than the 2-year yield, suggests cautious market sentiment and potential concerns about future economic growth. However, it's important to consider other economic indicators and factors to form a more complete assessment of the economic outlook and its implications for different market participants. Strategies and considerations. During periods of yield curve inversion, investors and businesses can consider several strategies and adjustments to navigate the challenges and opportunities presented. Here are some insights to guide investment and risk management decisions. Review portfolio allocation. In a yield curve inversion scenario, it is crucial to review portfolio allocations and risk exposures. Consider rebalancing the portfolio to ensure it aligns with your risk tolerance and investment objectives. Diversification across asset classes, sectors, and geographies can help mitigate risks and capture potential opportunities in different market conditions. Fixed income investments. Given the potential impact of a yield curve inversion on fixed income markets, it may be prudent to re-evaluate fixed income holdings. Consider shorter duration bonds or bond funds, as they may be less sensitive to interest rate changes. Additionally, explore high-quality bonds to mitigate credit risk. Maintaining a diversified fixed income portfolio can help balance the risks associated with yield curve inversion. Equity investments. While yield curve inversions may indicate a cautious economic outlook, equity investments can still play a role in a well-diversified portfolio. Focus on sectors that tend to perform well in economic downturns, such as defensive sectors like healthcare, consumer staples, and utilities. Consider companies with strong balance sheets, consistent cash flows, and competitive advantages. Regularly review and adjust equity holdings based on changing market conditions. Crypto investments. Investing in cryptocurrencies during a yield curve inversion requires careful consideration and a comprehensive approach. Cryptocurrencies, such as Bitcoin and Ethereum, are known for their volatility and can experience significant price fluctuations. Yield curve inversions may amplify market volatility, potentially impacting crypto prices. Therefore, it's crucial to understand and be comfortable with the risk associated with investing in cryptocurrencies. During periods of economic uncertainty, stablecoins can provide a measure of stability as they are pegged to stable assets, such as fiat currencies or commodities. Investing in stablecoins, such as Tether, USDT, or USD Coin, USDC, can help reduce exposure to the volatility of other cryptocurrencies while still participating in the crypto market. Remember that investing in cryptocurrencies carries inherent risks. Crypto is fairly new to the field, and we do not have enough information to evaluate it in comparison to other markets. Therefore, investing in cryptocurrencies should be considered part of a well-diversified investment portfolio and aligned with your overall investment goals and risk tolerance. Alternative investments. Alternative investments, such as real estate, commodities, and hedge funds, can provide diversification benefits during periods of yield curve inversion. These assets may exhibit a lower correlation with traditional stocks and bonds, helping to reduce overall portfolio volatility. However, carefully evaluate the risks and liquidity considerations associated with alternative investments before incorporating them into your portfolio. Risk management and hedging. Implement risk management strategies to mitigate potential downsides during periods of uncertainty. Consider using options or futures contracts to hedge against market volatility or specific risks. Establishing stop-loss orders or employing dynamic asset allocation strategies can help limit losses in the event of market downturns. Focus on cash flow and liquidity. Maintain adequate cash flow and liquidity in both personal and business finances. This can provide a buffer during economic downturns and offer flexibility to take advantage of potential investment opportunities. Evaluate cash needs, emergency funds, and liquidity reserves to ensure financial stability. Long-term perspective and patience. Yield curve inversion may be a temporary phenomenon, and its impact on markets and the economy can vary. Maintain a long-term perspective and avoid making knee-jerk investment decisions based solely on the yield curve. Be patient and monitor broader economic indicators and market developments to make informed investment choices. Seek professional advice. Consider consulting with a financial advisor or investment professional who can provide personalized guidance based on your specific circumstances, risk tolerance, and investment goals. They can help navigate the complexities of yield curve inversions and assist in developing a tailored investment strategy. Remember that strategies and considerations may vary based on individual circumstances, risk appetite, and investment goals. Regularly review and adapt your investment approach as market conditions evolve. Conclusion. Yield curve inversion is a phenomenon that occurs when short-term yields surpass long-term yields, signaling potential economic weakness or an impending recession. Through historical analysis, it has been observed that yield curve inversions are often correlated with economic recessions. In this discussion, we explored the definition of yield curve inversion and its occurrence, analyzed its historical instances, and delved into the theories behind why it is considered a reliable recession indicator. We also discussed the implications of yield curve inversion for various market participants, including investors, policymakers, and businesses, focusing on interest rates, borrowing costs, and investment decisions. Additionally, we analyzed the current yield curve shape based on the provided information, highlighting the potential implications for the economy and financial markets. We discussed the factors influencing the yield curve, such as central bank policies, economic indicators, and market sentiment. Considering the strategies and considerations during periods of yield curve inversion, we explored portfolio adjustments, diversification, risk management, and the importance of maintaining a long-term perspective. We emphasize the significance of seeking professional advice and staying informed to make informed investment decisions based on individual circumstances. In conclusion, yield curve inversion serves as a valuable indicator of economic conditions and can provide insights into market expectations and potential risks. Monitoring and understanding the yield curve is crucial for investors, policymakers, and businesses to navigate the changing economic landscape effectively. By staying informed, seeking professional advice, and considering individual circumstances, readers can make informed decisions regarding portfolio allocations, risk management strategies, and investment opportunities. Remember, the yield curve is just one tool among many for assessing the economic outlook, and a comprehensive analysis requires considering various economic indicators, market dynamics, and expert insights. Navigating the implications of yield curve inversion requires a proactive and adaptable approach, as economic conditions and market sentiment can evolve. Ultimately, informed decision-making and prudent risk management can help individuals and businesses navigate the challenges and capitalize on the opportunities presented by the yield curve inversion.